Greetings, and thanks for joining us for this Markets Live panel on investing at the lower bound. With the coronavirus pandemic pushing much of the globe into recession, the RBA joined peers, slashed rates, started buying government bonds. Governor Philip Lowe, though, has taken somewhat of a unique path, focusing on a 3-year yield target rather than promising to buy a set quantity of bonds. The RBA hasn't bought any bonds for more than a month, even as others, like the Fed, are ramping up purchases or at least promising to keep on making them. So in that environment, what challenges lie ahead for fixed income in Australia? When will the lockdown end for yields, or has it already ended? And how best can investors prepare for a post-virus bond market? Joining us to discuss all of this and more are Su-Lin Ong, Head of Economic and Fixed Income Strategy at RBC, Rob Mead, Pimco's Head of Asia Pacific Portfolio Management, UBS Macro Strategist Giulia Specchia, and Vimal Gor, Head of Bond, Income and Defensive Strategies at Pendal Group. So Giulia, if we could start with you, the RBA hasn't bought bonds for more than a month, while others, as I said, have been ramping up. Is Philip Lowe done at 50 billion and change? If so, what does that mean for fixed income investors?
Yes, we think that the RBA is done for the time being. The purpose of RBA buy bond was to stimulate the economy through targeting the trigger point at 25 basis point. And the trigger bond yield is close to 25 basis points, so that is done. And the purpose of buying bonds longer than 3 years was to bring liquidity back to the market. It was a fixable market kind of QE. And that has been successful as well. Markets are functioning. So the fact that they have been tapering, they've been skipping purchases just reflects that it's natural development, and it just reflects the fact that they've been successful in their policy. But having said that, we still think that if the economy doesn't turn up or it turns weaker than the RBA has in its base case scenario, or if the market is unable to absorb all the bonds that will be issued in the coming months, then the RBA will come back to the market in a more regular fashion. But for now, the curve is steep and is likely to remain steep.
Thanks, Giulia. Vimal, if we could perhaps bring you in at this point, if Giulia's thesis is correct, where then are the opportunities in Australian fixed income? What are you looking at in an environment where the RBA is taking a backseat now?
I think just on whether the RBA is taking a backseat, there are two ways you're going to approach quantitative easing. The first way is the way the US has done it up until now, apart from their QE infinity, which they give a set amount they're going to purchase over a set period, the same way the ECB has. That has the benefit that it pumps a lot of liquidity in the system. Now, whether that liquidity enters into the economy is questionable, because it generally just sits in excess reserves on bank balance sheets. But that's a way of getting money in the system. The other way is the way that BOJ's done and the RBA is now focusing on, is setting a yield level. And that means that you can push your yields to pretty much any level you want it to be, and you're given a commitment to hold them there as long as you need to in unlimited size, which is the way that Keynes originally postulated that quantitative easing should be done. Because if you set a yield level and you say you're going to be there in any size, well, then the market's not going to test you. It takes you to that yield level itself, and you actually don't need to spend any money. But they're very different ways of addressing the system. One is about getting liquidity into the system. The other one is about lowering interest rates. And it's arguable about which one is best, but we know that by pushing liquidity into the system, all we're generally doing is ramping up asset prices, and largely risk asset prices like of equity, etc. That's probably why the RBA has gone the second route, which is to target a yield level. So just back to your question, well, you're at 25 basis points in threes, and the RBA has told you they're there. Now there's a chance that they will go lower. They could move that lower. So our view is that you've got a free option. If you're buying threes, anything cheaper than 25 basis points, so yields higher than 25 basis points, it's a free option. Because you're going to be able to sell them to the RBA at 25, and you might get the RBA moving to a lower rate. And then it's just about what the value of the curve is, what the value of 10s is relative to steepness of the curve, and what's happening globally. Because Yes, the curve is steep. You get decent carry and roll down for being exposed in 10 years. But if the US is setting off, well, then that gives you a capital loss, which will hurt you. So it's really about weighing those two factors up. Effectively, the 10-year part of the curve now is just determined by yield curve steepness and its beta to the US market. That's pretty much all there is now. And I think that just the base case is you want to be long bonds, because I think the market expectations about the bounce back in growth are overcooked right now. And being long bonds in Australia gives you a good optionality on that.
Thanks, Vimal. A lot of very interesting points to raise there. Maybe picking up there on the last one, which will also allow us to bring in the first of our poll questions. So if we could bring that up now, which is, how low will the RBA set its cash rate target in this cycle? Are they done at 0.25, or could they go lower, and how much lower? So please, if you could respond. And that also gives me the opportunity to turn to Su-Lin Ong and ask you, Su-Lin, about what you think is going to happen with the RBA cash rate. I know you have had some research out talking about the potential for negative rates. So do you think that that's coming, which partly is a case of, do you think that the RBA is being a little bit too optimistic at the moment in how it thinks the local and global economies are going to develop?
So we expect the RBA cash rate to remain at 0.25% really for the next few years, probably at least 3 years. And that's very consistent, I think, with an economy that will recover over later this year and into 2021. But it's going to be a very modest recovery. There's going to be plenty of excess capacity that will keep wages and inflation low. And I think you will see elevated levels of unemployment for some time consistent with that. So the RBA is going to need to keep its official rate low and signal that, and it's done so pretty clearly, I think. In terms of the debate over could they go lower, the discussion around picked up in recent weeks right around the globe. It's been led by the likes of the RBNZ and the Bank of England, where they've put that option on the table. And in particular, the Bank of England appears to have really shifted its tone in recent weeks, to the point where our UK team is expecting the Bank of England to take its overnight rate down into negative territory in the second half of this year. And so I think there is a very big global debate around negative rates. There are those that are erring towards having it as an option, whilst there's others, including the RBA, the Fed, the Bank of Canada, that have said that it's very unlikely. And in our case, the governor's made it fairly clear, extraordinarily unlikely in his words. Our view very much is that it is a potential tool in the toolkit. It is unlikely to be anywhere near a first option. I think the RBA is at its very early stages of unconventional policy. It has a lot of other options before it would even entertain the idea of negative rates. So, it could very easily strengthen its forward guidance, step up its buying. It's been very quiet for the last 5 now. It could potentially lower its 3-year yield target or extend it further out the curve. It has a lot of options before it would head down that negative rate path. But I think what we've learned from the last few months is you probably never say never. And if there was, for whatever reasons, a global push towards negative rates, then there probably would be pressure on the RBA in that regard. But it's a long way down the track. I think circumstances, both here and offshore, would have to deteriorate quite substantially before the RBA even entertained that idea.
Oh, thanks. Well, Rob Mead, if I could bring you in to get your thoughts both on negative rates and also on what Vimal was talking about, about you're wanting to be long bonds, and do you agree that the longer end of the curve is now perhaps higher beta to the US and other global curves than it has ever been before?
Yeah, I'd say, building on all of the speakers' comments, I'd say the most important takeaway is that central banking is a global relative game. And if you allow yourself to be continually outdoved, which the RBA is doing at the moment by being quite upbeat on the economy, you end up with financial conditions tightening at the time when you don't really want them to tighten. And I think that's a really important message, that the revealed preference of the RBA is to do less rather than more. And that's, again, as the other panelists have all mentioned, that's a pretty consistent theme where you see other central banks doing a lot more. So this whole concept of avoiding dysfunction rather than having some sort of target, it's a bit of a misnomer to call it yield curve control when all you really care about is a 3-year point. And you also have, as some of the comments already, that the cash rate at 25 basis points could very well still be there in 3 years. So there's not much yield curve control going on. The market pricing of that expectation would take it almost there anyway. In terms of investing though, and I think this is the most important thing, is that as Vimal mentioned, at 25 basis points, 3-year, give or take a handful of basis points, investors want more than 25 basis points. And I think there's plenty of opportunity for them to earn more. And if that means moving a little bit further out the curve, into semi-governments, into agencies to some degree, in that 5-7 year part of the curve that will very effectively roll down towards 25 basis points, whether that means buying some high quality credit. We've seen the reaction function from the Fed, from the ECB, from the Bank of Japan, all being very supportive of their high quality credit markets, whether that be in securitized form, whether that be in agency mortgage form or in corporate credit form. And to be able to pick up literally percentage points for taking very little additional risk, we think makes perfect sense. And final comment would be, there will be a great opportunity in distressed credit as well. While economies are recovering, they're not moving back to where they were anytime soon. Certain sectors of the economy will enter into distress. We think that the way covenants and security, etc., was transitioning up until February this year, bondholders didn't get much support further down the credit curve. In the next 2 to 3 years, they're going to be tremendous support, tremendous levels of subordination supporting bond investors. So that would be where we would be advising investors to think about going forward.
Well, thanks, Rob. I mean, one matter that gets raised by all of this is the question of what is the bond market trying to tell the rest of the world. We've talked about and whether it has anything to say now that central banks are so in control of everything. We've talked about a very steep curve in Australia and also elsewhere, which is actually not the sort of thing that you would necessarily get at this stage of where we seem to be in the economic cycle. So perhaps, Su-Lin, if you would like to comment, is this steeper curve a function of economic recovery, or is it more about massive supply?
I think globally, the steepness of the curve reflects markets pricing out the worst case scenario and pricing in the possibility of a V-shaped recovery. And we saw that in the sell-off of the backhand in Australia and globally starting in June. There was some talks that part of the steepening might be driven by the fact that the governments everywhere have announced big issuance programs in response to the coronavirus. But the reality is that this was probably a driver in mid-March and towards the end of March. And after that, central banks stepped in. And effectively, what they said is they committed to buy all the bonds that the market is not able to orderly absorb. So all this demand driven by central banks effectively offset the impact of the issuance that is coming on the back of the coronavirus. So the steepness of the curve in general, in global curves, I think is related to the pricing from investors of a recovery in the economy. In Australia in particular, is also related to the fact that the RBA has been skipping purchases for the past weeks, and that it's in a contrast to central banks elsewhere.
Okay, maybe I think Su-Lin wanted to talk about steep yield curves and what she sees driving those.
No, I very much agree with those comments from Julia. I think it is very much about markets that are very forward-looking, that have been encouraged by the easing in restrictions here and globally, albeit at varying pace, that are looking at a stronger economy at some point over the medium term. So that's really supported a broad risk complex, and steeper curves in that regard. I guess we are a little cautious. I think there's still a fair degree of uncertainty, and it's twofold, and that I think will temper the degree of steepening that we see at times with that type of optimism. I mean, the first really is around the virus and the accompanying measures. The trajectory of this virus and the measures will very much determine the trajectory to a large degree of both the domestic and global economy. And there is a great deal of uncertainty. It continues to rise in the emerging world. There's risk of a second wave, particularly in the likes of the US. And so we are a little cautious on that front. But I think more importantly, while we may have seen the worst in terms of the contraction in activity and the maximum amount of job shedding, both here and offshore, it's still a very substantial contraction in activity that we're seeing at the moment, and recession. And the path out, I think, is still fairly modest, uncertain, and will be fairly bumpy at times as well. In Australia in particular, there's a number of headwinds to activity that have been around for a long time: low productivity, elevated levels of household debt, stagnant wages, and you put all of that on top of what will be a weaker labour market. So I think this idea of optimism, a path straight out, much stronger growth, and that type of sentiment underpinning risk markets and the steeper curve, I think there is reason to be cautious on that front.
Thanks, Su-Lin. And I think now would be a good time to turn to our second poll question, because I was also wanting to come to Vimal with exactly this kind of query. So we're asking, where are the most attractive opportunities likely to be in the coming year? Longer term government bonds, which already seem to have a couple of votes, semis and supras, bank bonds, or non-financial corporates. And again, just before we switch to Vimal, here's wherever you go, you're seeing that's already coming in. I did want to remind the audience too that, as well as responding to the polls, we'd be very happy for you to send in some questions via the app, which then I can put to the appropriate panel members. So with that out of the way, Vimal, where do you think the most attractive opportunities are likely to be in the coming year? Are there any particular sectors that really stand out for you?
I think if we come back to that last question and tie it into this one as well, I question whether the steepness of the curve is to do with the economic data, or whether it's just the fact that it's all about supply demand, really the central banks. I mean, you look at the Fed. The Fed's controlling every market now. You would be hard pressed to argue that we're in a free market system in any asset price in the US. They've told you where they want high yield to be. They're buying IG ETFs. They're effectively controlling the price of equity markets. They're explicitly controlling the price of bond markets. How much information from the economy is finding its way into asset markets? I really question that. So therefore, onto this question: well, what do you buy? You buy the stuff the Fed wants you to buy. You lever up in low grade investment grade credit, low grade credit. You leverage up in fallen angels and high yield. And you effectively just buy the stuff they told you they're going to buy, which is a wholly unsatisfactory way of running assets. But there's no price discovery in this market anymore. Markets don't move on underlying economic data. We can see that with the wedge that we've seen develop between the S&P and the US economic data. I mean, the markets are all being driven solely by government policy now, whether it be explicit government policy or implicit government policy by the central banks. So you literally just buy what they're telling you to buy, and it's wholly unsatisfactory, but there's nothing else really to do. And then along with that, you buy a little bit of tail. You own some vol on the side of that just in case the situation comes to unravel. And that's kind of the only thing you can do. And over the longer run, I don't know. I mean, longer run, 5 years plus, I don't know if there's even a role for government bonds in this market anymore, because the central banks will pretty much own all of them. The Treasury will issue them, the central banks will buy them, and they won't trade. It'll just be like Japan.
something of a grim outlook, especially for fixed income investors. Although there are still plenty of those in Japan, even if quite a few of them seem to be foreigners who are taking advantage of the basis swap magic. Moving on, I wanted to come back to something that Rob hinted at. It was talking about tightening of financial conditions, which the RBA seems to be willing to accept. And one thing that's definitely been something of a surprise has been how strong the Australian dollar is. The trade-weighted index is back to the highest it's been in more than a year, which in fact is 180 degrees away from what the RBA was saying last year would be part of the aim of unconventional policy tools, that they might well be transmitted via the currency channel. So perhaps if we could turn to Giulia to start off with, what do you think the role of the Australian dollar is turning out to be in this? And is that in any way a concern for where fixed income assets are going to go in Australia?
Well, like, we were very surprised that the RBA didn't try to talk down the currency at the June meeting. The Australian dollar is indeed one of the key transmission mechanisms for monetary policy for the RBA, and the fact that it has strengthened that much is clearly a headwind for the economy at a stage where we are going through a recovery in Q3 and Q4, but the pace and the shape of this recovery is still very uncertain. So we think that ultimately, if this trend persists, the RBA will have to do something about that. They may try to talk it down. They may try to actually ease policy. If they go down that path, one possibility is cutting the cash rate to 10 basis points, so delivering some sort of a mini cut, and that would have an impact on the currency. Another possibility is terming out yield curve control. So instead of targeting the 3-year point, they could target the 5-year point at 25 basis points, and that will also stimulate the currency and stimulate the economy. So they still have a number of tools that they can use to lower the currency if they want to. So, I mean, our bias on the Aussie curve is still a book flattening bias, just on the medium term, just because we think that eventually the RBA will have to do something on the currency, or because there will be there's still a lot of uncertainty about the path of a recovery for Australia and globally.
Thanks, Giulia. So then perhaps if we could turn to Rob, both looking at, at the poll question, and also we've got a question that's come in from Campbell Stevens at Van Eck, which is that given developed market bonds are effectively negative, would you invest in emerging market bonds? And what would be some of the risks that investors could expect in those markets?
Yeah, I'd say a couple of things. First of all, as central banks navigate essentially from crisis management to trying to keep financial conditions easy, I think there's going to be a lot more opportunity than many investors expect. So at the moment, everybody's getting some sort of uplift, but that will only be temporary. So as we move through this phase, I think there'll be a lot more differentiation between the winners and the losers. At the moment, everybody's more or less winning, unless you've got something in your sort of corporate structure that means it's very hard to value out. And we've got one of those examples in our own airline industry. So those sorts of things we think will become will shift quite quickly. In terms of the understanding what's driving markets, I think that's a really good point, that understanding which markets are going to be provided with the most support, even on the other side of the crisis, is really key, and investing in line with that mindset makes perfect sense. So I think that sort of as we transition into that phase, we have to sort of keep that in mind, and then accordingly invest on parts of the yield curve, or investing in currencies, long or short, that provide some of that defense. I think in closing from my end, it's been very clear that no matter what level of bond yields we when things go awry, bonds turn out to be defensive every time. And so owning some of that defense across a balanced portfolio continues to be an absolute important key ingredient that every investor shouldn't forget. Even if rates move into negative territory, there's still the ability for some of those bond markets to generate positive returns. So I think that's the most important takeaway, no matter where we migrate to in terms of an interest rate level.
Thanks, Rob. That actually lets us just quickly throw to our final poll, if we could do that. How do you expect investors to change their portfolio allocation to fixed income over the rest of 2020? So please respond to that. And speaking of responding, I wanted to turn to Giulia Specchia and ask a question from the audience about what's the inflation outlook? We have short-term deflation. In the longer term, could it rise? And if so, how does that impact your views on bonds with yields as low as they are?
Like our expectation, so at the moment there have been a lot of fiscal packages announced in Australia, New Zealand, and everywhere else in the world, and these usually, should lead to inflation. But this time around, these packages are just covering these massive holes in the economy that have been created by the shutdown. So we don't think that they will create any inflation, just because, as I said, they're just covering for these massive holes in the economy. But going forward, perhaps it will depend really if there will be reforms aimed at boosting productivity, or if there will be additional fiscal package aimed, stimulating the economy after the coronavirus outbreak, after we have gone through this crisis. So it will depend on what happens next. For the time being, we don't see any inflation coming. So that's part of the reason why we have a bull flattening view, just because as long as investors don't need to buy protection, then they're willing to pay more for nominal. So that support bull flattening of the curves.
Okay, Giulia, thanks very much. Unfortunately, that is all we've got time for. Although I personally could sit here all day and listen to the wisdom that's been coming from all of you. Thanks so much for joining us for this inaugural Bloomberg Inside Track virtual investment summit for the Australian economy and for Australian assets. And we look forward to seeing you at future events.